This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, we finished our first lecture on employment income, dealing with the assessable benefit regarding living accommodation provided by the employer. And now, well, you may have chosen to look at it yourself, I don't know. But now let's have a little look at example 2 that tests out our understanding of how to compute such a benefit. Again, we're told here to assume an official rate of interest of 3%. That percentage figure will be provided on your rates and allowances page. We want, of course, the assessable benefit for 1617. Jones, a sales manager, occupies a flat owned by his employer. Its annual value is $4,000. Owned by his employer. It's not rented, therefore there is no rent, it's the annual value. So the first thing that we will be including as regards determining the overall benefit is indeed that annual value, and that is £4,000. Jones pays his employer £500 per annum for the use of the flat. Again, this will be an allowable deduction, which we'll show in a moment. First of all, though, we determine, is there any expensive accommodation benefit? Now here there will be, we'll see why in a moment, there will be this expensive accommodation benefit to be computed. Why? The flat was originally purchased in 2008 for £100,000. Just like an example I quoted to you, we discussed at the end of the previous session, that is at least £75,000, and that makes the accommodation expensive. So it's purchased in 2008. But this employee, Jones, only moved into the property in 2015. That therefore must be more than 6 years from when the company first purchased that property. So as 1, it's expensive accommodation, and 2, it's more than 6 years owned by the employer when the employee moved in. We use the market value of the property when he moved in, and that's the 120 rather than the original cost of only 100,000. So the expensive accommodation benefit, therefore, we've seen that we use the market value when provided to this employee rather than original cost, minus the expensive accommodation cut-off limit of 75,000 times the official rate of 3%. So 120 minus 75 is 45,000 times 3%. That I think is £1,350. Add that in and we've got £5,350. Less the employee is required to pay rent to the employer for the privilege of occupying the property, and the amount of rent paid by the employee is, we were told, £500 for the year. So 500, take it away, and that therefore will bring us down to, for 1617, a taxable benefit of £4,850. Now, if a company is providing company accommodation for the benefit of the employee there, then not only might the benefit extend to the provision of the accommodation itself, but it's also quite likely that the accommodation may be furnished, so there are furnishings and furniture made available there. That's another benefit. And the employer might pay for the bills, might pay the gas and electric bills for heating and lighting, might pay the council tax there. Again, a significant figure. That's a local tax payable in relation to residential property. So any costs, therefore, incurred by the employer on behalf of the employee are also going to create additional assessable benefits. And if furniture and furnishings are provided, it's a furnished apartment there, or flat, or house, or whatever it might be, then that's another benefit to be computed. So how do we deal with these, therefore? Well, if we just wind on to section 7.1 here, expenses connected with living accommodation. Well, that's very easy because you will be taxed there if they are paid for by the employer. So taxable on the employee if they're paid by the employer. Now you'll be told that the employer paid the electric bill, the gas bill there, the council tax. Those are costs that should be incurred by the individual in relation to the property that they live in. Therefore, if paid for by the employee, they are assessable benefits. Now again, be careful. I've seen students make a common mistake here, where what the question tells you is that the employee paid for the heating and lighting, paid the council tax of X hundreds and thousands of pounds there, whatever it might be. And what students do is then go and deduct those payments made by the employee for those costs, the gas bill, the electric bill, the council tax. They go and deduct it in deriving the assessable benefit. No! They are not deductions in deriving the assessable benefit. All it means is that they've paid their own gas bills, their own electric bills, their own council tax, just like everybody else has to. So the fact that the employee has paid it does not give rise to an allowable deduction against the assessable benefit. It simply means that there's no additional benefit now to add in, which would and will be the case if the employer is paying for those amounts. One provision here to watch out for, again it's rarely tested but it may be, if the accommodation was job related. Now remember that if the accommodation was job related, then there would be no assessable benefit regarding the actual accommodation itself. So the annual value, the expensive accommodation benefit would not apply if it were job related. Then, in relation to these expenses paid for by the employer, and also in point of fact, as regards the furniture and furnishings, so the use of assets provided by the employer, we put a cap on what the maximum taxable benefit could be. And that taxable limit placed on this is 10% of our other employment income, that is, excluding these other benefits, other employment income. In addition, the payment of council tax by the employer is an exempt benefit if the accommodation is job related. So if it's job related, then you're required to live there, like a caretaker for a school, required to live in a property on site to deal with any emergencies that might arise at any point of the day or night. Now that job might not be particularly highly paid, but the benefit that attaches to the property could be huge by comparison, and that therefore could give an inordinately high tax charge for the individual then to pay, who's actually on a pretty low figure of salary. So where you're required to be there are no benefits in relation to the provision of the accommodation itself, no annual value, no expensive accommodation benefit. As regards expenses incurred, council tax, that's this local tax paid, that one is picked out and is an exempt benefit if it's job related. But your electric bill, your gas bill, your telephone bill, any other bills there paid for by the employer, we put a cap on. And that cap is 10% of the individual's other employment income. So we can't end up with a benefit that's a ridiculously high proportion of the employment income that this individual enjoys. We put a cap on it of 10%. Again, only relevant if it's job related. If it's not job related, as the vast majority of questions are, then all of those costs, the gas bill, the electricity bill, the council tax, will be further assessable benefits in relation to the provision of that accommodation. Along with, if it's a furnished accommodation provided, rather than the employee furnishing it himself, then there is a further benefit which it's not a specific benefit on furniture and furnishings. It is a specific benefit for the use of assets other than those that have their own specific rules. Certain assets are picked out within the legislation and they are dealt with independently. So again, once we finish with this area here, we'll be moving to the main one, probably a company car. Their cars and the fuel provided for them have their own specific rules. Vans, indeed, have their own specific rules. So there are certain assets where this is what you do, like with the living accommodation up until now. But then there's a generic rule that applies to any and all other assets bought by the employer and made available for the private use of an employee. Most typically, where this rule is tested is here, where the employee occupies accommodation furnished by the employer. And the generic rule for dealing with such assets is, as an annual benefit, we take 20% of the market value of the asset, the furniture and furnishings in this case, when first provided. Now that is most likely other than being rental paid by the employer if the asset is rented. Again, don't imagine that they'll be renting the furniture and furnishings. It will have been bought by the employer. So if, for example, we had this information, so make a note of the following information, please. Oops. We're told employee has the use of an apartment purchased by the employer in 2014 at a cost of £200,000. Employee occupied in late 2015 when the property was furnished by the employer at a cost of £20,000. We're further told that in 2016-17 tax year, employer paid property expenses. Now again, you be told what they were. I'm not going to bother listing out individual things like the gas bill, the electricity bill, etc. Property expenses of £4,000. And based on that information, we then need to determine what the assessable benefit is for 2016-17. Now, one thing always to be careful of here when attempting to compute these benefits is to understand that both in relation to the living accommodation and the use of assets, and most of the other benefits we'll go on to discuss in this chapter, that they are annual benefits, i.e. it presumes that the benefit has been provided for the entirety of the tax year. So you need to make certain that the employee has indeed had that benefit for the entire tax year. Well here, yes, employee occupied in late 2015. Therefore, assuming they have continued to occupy until the 5th of April 17, they have been in the property throughout. If, for example, you were told that the individual employee had taken up occupation of this apartment on the 1st of July 2016, had occupied from the 1st of July 16, that would be part way in to the 16-17 tax year. So for how many months of the tax year had the benefit been provided? From 1st of July 16 to 5th of April 17, that would only be 9 months. So once we have computed the overall benefit, we will take 9/12 of that as the taxable benefit for the tax year. So do always check out, when was this benefit first provided, or indeed when was it removed? And if either of those dates are within the tax year, then you'll need to time apportion what is otherwise an annual benefit that we compute. Right, one other piece of information there that you should be told. Now look at the information, and what information have I not given you that you need to be able to work out what the total assessable benefit is in relation to the living accommodation. Remember, the components are the benefit of the living accommodation itself, any expenses paid for by the employer, running costs of the property, and any furniture and furnishings made available. What rule do we use there on the use of assets? So I told you what was the cost. That was incurred in 200,000 in 2014. The fact that this employee didn't occupy until late 2015 doesn't matter. They might tell you a market value at that date. It would be irrelevant, because there the company, the employer, had not owned the asset for more than 6 years prior to this employee moving in. So it is the original cost of 200,000 that will form the basis of the expensive accommodation benefit. We know what the cost of the furnishings were, cost of 20,000, and we know what the running expenses are. So what's the missing ingredient that we spoke about last time and was involved in the example we did a few minutes ago? It is, of course, the annual value of the property. So I'll now tell you that the annual value of the property was, let's say, £5,000. Again, important as you read a question that you know what you're looking for. You should not simply be reacting to the information provided. You should know, when you see living accommodation, right, what am I looking for? I've got to check, is it owned by the company or rented? If it's owned by the company, then I want the annual value there of that. What I also then need to know is, what was the original cost? Does that exceed, or is it at least £75,000? When was it purchased? When did this employee move in? And if the employee moved in when after the company had owned it for more than 6 years, then I would need to know the market value at the date the employee moved in. I also need to know what was the market value of the furniture and furnishings when the employee moved in, and I also need to know the running costs. Let's put that together, therefore, now in working the assessable benefit. Firstly, as regards the accommodation, you simply pick up the annual value. That, we're told, is £5,000. There, no work to be done. It's a copy down exercise. There is the expensive accommodation benefit to compute. That will need to be included. That's a calculation you need to do. There will then be the running costs. Not a figure that you can work out for yourself. These running costs paid for by the employer, those property expenses. Again, a straight copy down from information in the question, here 4,000. Then one that you have to work out, the benefit for the use of the assets, the use of the furniture and furnishings. So of the 4 numbers, 2 must be given to you. The expensive accommodation benefit shouldn't be difficult. Here that cost of 200,000 is the figure to use. It exceeds 75,000 times 3%. 200 minus 75 is 125. 3% of that is, I think, but do check, £3,750. The use of the assets there, what we need, let me just go back to the note and show you. On the use of assets, 20% of the market value of the asset when first provided. Now that, we're told here, was a cost of, what was it a cost of? That was a cost of £20, £20,000, that's cheap, a cost of £20,000 there. The market value when first provided for any employee's private use there. So if this had been bought as it was in 14, immediately furnished and put the furniture in and furnishings at a cost of 20,000 and made available to an employee, and it's the same furniture and furnishings in there in late 2015 when this employee comes in, it doesn't matter that at that date in late 15 maybe the market value was less than 20,000. It is the market value when first made available for any employee's private use. So that here is £20,000. What is the rule that we apply on this generic rule for use of assets? We take 20% of that market value when first made available, and 20% of 20,000, that would be £4,000. Job done. Use of assets. Now, other thing finally to check, was the property made available for the whole tax year? Yes, it was. So these annual benefits do not have to be time apportioned there. Was there any rent paid by the employee? No, there wasn't. So that will be it in relation to these benefits. Add them up. 3,750 is 8,750, plus 4 is 12,750, plus 4 is, I think, £16,750. A big accommodation benefit there, therefore. Okay, have a look through, make sure therefore that you are happy with that before we then progress on to the next aspect of this connection with the provision of assets, and that is if the assets are actually bought by the company and then gifted, maybe sold at an undervalue to the individual, how do we deal with that? But before we move on, go back over living accommodation, make sure you're happy with it, spend 3 or 4 minutes doing that, because that one is a frequently tested area. So make sure you've got that before we progress. Okay, well, we've seen therefore in the context of furniture and furnishings made available within living accommodation that is used by an employee of the employer, that we have a generic rule about use of assets that is applicable there, which says we take as the annual benefit 20% of the market value of that asset when it was first provided for any employee's private use. What happens now, therefore, if the company actually gifts an asset? The employer gifts an asset, buys it, gives it away to the employee. First situation, probably not one that you'd see because it's too easy. And that is, if an employee is gifted a new asset, he's simply taxed on the cost of the asset. So the employer buys a sofa costing £1,500 and then gives that immediately to the employee. The assessable benefit, quite obviously, is the cost of the sofa, £1,500, just as if the employee had gone out and bought it himself. £1,500 would be the assessable benefit. If an employee is gifted an asset that has previously been used, then he's taxed on the higher of. Now, this is much more likely to be the object of any exam question. But initially, what was then still a company-owned asset was provided for the private use of the employee. And during the time that it was a company-owned, an employer-owned asset, we have used that rule 20% of the market value when first provided to an employee. What now happens where that having had the use of what was a company-owned asset, the company says, we don't want that on our company books, we're going to sell it to you or give it to you. What happens therefore, if either it's been gifted or, as is most likely, sold indeed at some relatively low value to the employee. Right, we now need to pick up from the information in the question the higher of two figures. That is, one that must simply be given to you, the market value of the asset when given to the employee. That's simple enough, it's given. But there is then one of these two things that need to be established that you need to compute for yourself. And this is where the work goes in. It's also probably going to be the figure that will be the higher of these two figures, so you're going to need to know it. It is, what was the original market value of the asset when first made available to the employee, less the benefit assessed on the employee during the time that he had the use of it. So this is again going back and using the 20% rule. So if we take that original market value less the benefit assessed, the time we could give this, we could refer to this figure as the tax written down value, as the tax written down value of that asset. These rules do not apply to the gift of either a car or a van, where simply it's the market value of the asset when gifted. That is it, you use that. That assumes an outright gift. Obviously, any price paid by the employee would reduce the amount of assessable benefit. Okay, we've got just one example here to illustrate and to complete this particular session. We're told, Gerald's employer purchased a TV for his use on the 1st of June 15, and at that date it cost £900. Then on the 6th of April 16, so the very first day of the 16-17 tax year, Gerald was given the TV by his employer, its market value then being £250. Calculate the benefit assessable on Gerald in respect of the gift on the basis of, if Gerald made no payment for the TV, it was just an outright gift, so it is the higher of its market value. We know that, 250, or what will be the higher figure, its tax written down value. The market value when provided, that was the cost of £900, less the benefit assessed on the employee during the time that he had the use of it. Now that is not very long, it's from the 1st of June 15 through to the 6th of April 16. All that will then happen is, in the next example, if Gerald paid his employer £250 for the TV, whatever you computed in A is reduced by £250. So, the assessable benefit, therefore, for Gerald in respect of the gift here is the higher of. Now we know the market value, £250. So the figure that we've then got to calculate is the tax written down value. So what was the open market value when first provided? That was its original cost. That was £900. Less any assessed benefits up to the date of the transfer. Now, as you can see, it was first made available on the 1st of June 15 before being transferred on the 6th of April 16. So what we've now got to work out is what were the assessable benefits within the 15-16 tax year. Now we know that the annual benefit is based on, what was that original market value? 900 times 20%, the use of an asset. But that is an annual benefit, and this was not available throughout the entirety of the 15-16 tax year. Therefore it needs to be time apportioned. Gerald only got it from the 1st of June 15. So count through from the 1st of June 15 to the 5th of April 16, and that, I hope you will agree, is 10 months. So times 10 twelfths. So 20% of 900, well, that would have been 180, times 10 over 12, and that therefore will give you £150. Now that would have been the assessable benefit in 2015-16 tax year. As it was transferred at the 6th of April 16, there's no equivalent annual benefit to work during the 16-17 year. If, for example, it hadn't been transferred on the 6th of April, but had been transferred on, say, I don't know, the 1st of July, that would have meant for April, May and June, you would be computing again an annual benefit, just as you've done here, but now for 16-17. That would again be 900 at 20%, but for April, May and June it would be 3 months worth thereof. So you calculate the amount of benefits assessed from the date that it was made available to this employee to the date that it was transferred to the ownership of the employee. As that was the 6th of April, start of the 16-17 year, there is no additional annual benefit to compute in the 16-17 year. So its tax written down value is £750. Is that higher than the market value at that date at £250? Well, of course it is. So in terms of Part A, there's the assessable benefit in the 2016-17 year arising on the gift of that asset. In B, if Gerald had paid his employer £250 minus £250, well, that would be £500 then as the assessable benefit. As I say, this tax written down value computed there at £750, if you had, or if the employer had transferred the ownership of the asset part-way through the tax year, you'd have had to have worked your equivalent time apportionment, as we just suggested a few minutes ago, for 16-17, which would further reduce that tax written down value. Okay, now that rule, remember, is for any other assets than those that are specifically dealt with within the legislation. Living accommodation, as we've already seen, is specifically dealt with. What we will then see next time is probably the most likely assessable benefit that is going to be tested in probably the vast majority, if not the entirety, of all examinations set. And that is dealing with the car benefit, potentially further increased by a fuel benefit, if indeed the employer is paying for the fuel for the purchased car, for the company car provided. All of that and the remaining benefits, or as many of them, probably the next lecture will be entirely occupied by dealing with car benefits, to be fair there. But again, we will then complete our studies of assessable benefits over the remaining lectures. Okay, in which case I look forward to talking about cars, indeed, to you next time around.